Now, we've all heard of top-down analysis, and top-down trading is basically the same thing, but used to enter into the market using smaller degree timeframes and patterns to trade for a higher degree price target. Okay, top-down analysis is basically where we're looking at the weekly chart, the monthly chart, the weekly chart, daily chart, 4-hour chart to isolate direction and looking for good trade opportunities even on the small degree timeframes. Whereas top-down trading is where we are actually trading that 4-hour time frame pattern, but we're using the 15-minute chart potentially to enter into that trade. So we're using a stop loss based on the 15-minute pattern while we're using the targets from the 4-hour chart. First, we identify the larger degree pattern we are looking to enter into, and then we isolate a probable support and resistance trading zone. Once price trades into our predetermined support and resistance zone, we then drill down to the smaller degree chart and look for a trading setup on that smaller degree. Okay, so instead of having to use just a limit order with a really large stop below or above the beginning of the pattern on the 4-hour chart, basically now we're drilling down and we're using that 15-minute setup to get us into the trade. All right, which obviously this allows us to have a smaller stop loss in the trade because we are using the smaller degree pattern for entry while still targeting the higher degree time frame targets. And trading this way creates some absolutely ridiculous reward to risk ratios. Okay, so an example, we've done our analysis. This is the Kiwi dollar. We're on the 4-hour chart. Okay, we've had a rally here and we're looking at this as a corrective setback, and we've isolated this 50 to 62% zone. Now, when price came into this zone, we can either have a limit order here, wait for a candle pattern on this particular time frame, or have a limit order with a stop loss down below the low. Now, with a stop loss down below the low, what does that mean? That means from this particular time frame, if we have, let's just say we have a limit order in, we'll just use the 50%. Stop loss needs to go below the low of this pattern. And the target, let's go ahead and measure from the low. We would have adjusted that target for the low of this swing, which would have put us at 75.57. All right, so let's adjust this to 75.57. There we go, close enough. Okay, so that gives us a reward to risk ratio of 1.6 for the 1, which is okay. It's okay. We have 152 pips stop. So now let's go ahead and drill down to the 15-minute chart at this same time and see what was happening here. We're going to isolate this area right here. Now remember, we're already looking for something to develop at this level. Price moving lower, MACD cycling higher. We didn't see any qualified setups in here. Potentially could have maybe took an entry on this candle. Would have liked to, if we're trading this from the higher degree time frame, probably would have waited for a qualified setup here instead of trading that kind of a candle pattern. But this candle right here, I mean, look at that. Look at that bullish inverted hammer. Right at a key level on the 4-hour chart. Okay, so now what do? Now we go ahead and enter the trade 3 to 5 pips above. Let's make sure I have the right long position here. Now we're entering into this trade 3 to 5 pips above. So let's see, this candle closed at 72.47. Just call it 72. Right there, it works, 52. And now we need to adjust this so our stop loss goes below that low. And our target now, okay, our target, remember, is 75.57. 57. Okay, so 75.57. We're targeting the higher degree time frame. So 75.57, close enough. How about that? 3.25 to 1 reward to risk. Okay, with a 93 pip stop. Now, that was just an example of using a candle pattern, just the candle to enter into the market. Here's an example on the Aussie yen pair. All right, we had identified a level of potential support. Okay, so a potential buy zone right here. And when price came into this level, we could have looked to buy this either with a limit order or entered at the 50%, or we could have watched the smaller degree time frame for a price reaction at this 50 to 62% zone. You can see here we don't have any kind of divergence or anything, so we're just getting a little reaction here, and from the candles we're not seeing very much of nothing telling in here. And if we just use the limit order, let's just see where that would put us as far as, actually the very first thing I want to do is measure from our back to the swing point here. So our target level would be 94.37. Okay, so 94.37. Let's just say we entered long at the 50%. Target 94.37. Right there. And our stop loss has to go below the low. All right, so we have a 1.82 to 1 reward to risk. Okay, not too bad. Okay, and that's assuming that you entered right there at the top of the zone. Now, let's go ahead and look at the 15-minute chart and what happened here. Here's the 15-minute chart, and look what's happening. We have price moving lower, MACD cycling higher here, and then we have an extension. Okay, from our low. Let's just go ahead and draw we'll change the template here for how to put our extension on there. You see price well extended on this cycle, well extended through the 162. Once this market extends, we can enter. We can enter. Once this cycle extends, we can enter this trade. Now, let's go ahead and do a measurement on this. Remember, 94.37, right? And I'll even raise this a little bit higher because this is a pretty, once this extended right here, actually the market did pull back, and we could actually enter right there on the 162. So, and I'll just say we'll even pull it back here just above that candle a little bit. Now our stop loss needs to go below this low. Okay, so we have about a 46 pip stop, and we're targeting 94.37. $94.37. There we go. Look at the difference. It's a 4.66 to 1 reward to risk ratio. Okay, and that's by isolating a level, a buy zone on the higher degree time frame, okay, on the hourly chart, and then using the setup on the smaller degree chart, in this case the 15-minute, where we got a divergence and an extension to enter into the trade, giving us a smaller stop loss and a much better reward to risk. Okay, so basically you can see top-down trading is where we will set up our trading zones on our higher degree time frames, and then we'll look for patterns or look for qualified setups on the smaller degree time frames, extensions, divergent setups that we're going to show you here shortly. And this is actually the extension entry method that we're going to cover here very soon. We haven't even covered it yet. So you have a little preview here. But using this technique, can give you really good reward to risk ratios and help boost your profits.